Okay, so welcome to Learning Objective 3 in Chapter 6, which really talks about two things, and they're relatively, easy to understand. So this shouldn't take us too long to get through. Um, One is sort of looking at inventory on the balance sheet because that is something that inventory is going to be on the balance sheet, and it is something to know about. Another is we're going to be introduced to some financial analysis of inventory. Right? So you're going to get financial analysis piece by piece, part by part, all the way through until we get to that last chapter. So remember, inventory is a current asset, right? So it's going to be on the balance sheet. Um, and of course, once we sell it, it's going to go over to our cost of goods sold, which of course is on the income statement. So one of the things that we have to sort of understand is that companies have to decide many different things in which they disclose to their owners and to the public when they do the statements. First, they have to go ahead and explain what we were talking about the other day, what cost method they use when they value their cost of goods sold in their inventory. Um, they also have to tell us something that you're going to be learning about today, which is the basis for the accounting. Most assets are listed at their cost. Okay, and that's the norm. Historical cost is the norm. However, sometimes certain assets change in value quite rapidly. And so another basis for accounting that you're going to be learning about is something called the lower of cost or market basis. And sometimes companies have to use that as well. So we're going to learn about that today. And of course, companies have to classify their inventory, particularly if they are in manufacturing. Okay. So here is some notes from Walmart's financial statement. And here they tell you that they actually value their inventory at what we're going to be learning about today, the lower of cost or market basis. Okay, so we're going to be learning about this. And they also use LIFO for all of their US store inventory. Okay. So they disclose these things in the financial statements. Okay. So let's talk about this lower cost or market basis and what it's really about. Okay. Sometimes the value of inventory is lower than what you actually paid for it. Now, normally we would list the asset at the cost. But if we listed inventory at its cost, and we know the value of the inventory is lower than the cost, we would be overstating the inventory value on our balance sheet. And we can't do that. We have to be conservative when we value our assets. So basically, companies on occasion need to sort of write down the value of that inventory because the value has changed dramatically. Okay. So what do they look at? Well, they certainly look at what they paid. So they look at the cost of the inventory, but they also look at what the market value is of that inventory today. And market value simply is if they went out and bought it again today, what would be the replacement cost? And simply, in order to make sure that they are being conservative with their numbers, they simply pick the lower of those two numbers. Okay, sounds confusing. Actually, it's quite simple. So here's an illustration, and welcome to Kentucky TV. I am Kentucky. This is my inventory. We got some of them there flat screen TVs. We got satellite radios. We got Blu-ray players, and we got some CDs. Okay, with a lot of inventory. So let's take a look at our flat screen TVs. We got 100 of them in our stock. We actually paid, that's the cost, $600 for each of these TVs. However, if we bought it again today, we would only pay $550. So the lower of cost or market would say we value it at the lower, which 550 is the lower of the two numbers. So these 100 TVs will be valued in inventory at 550 or $55,000 worth of televisions in our store. Please pay attention. We got 500 of them there satellite radios. We paid $90 for them. That's our cost. If we bought them again today, it cost $104. So we're going to use the lower of the cost or market, which is in this case, the $90 is lower cost. So each of these 500 radios are worth $90. So we have $45,000 worth of radio. We got 850 Blu-ray players. We paid $50 for them. That's our cost. But if we went out on the market and bought them again today, we'd only pay 48. So 48 is the lower of the two. So these 850 are worth $48 each. So we have $40,800 worth of inventory. We have 3,000 CDs. We bought them at $5. If we replace them all today, it would cost us $6. 5 is lower, so we're going with 5. That's our value of our CDs. This is the total amount of inventory that we would be putting on the balance sheet using the lower of cost or market basis. So it's very, very practical. It sounds really like what, but when you actually sit down and do it, it's like, oh yeah, this is nothing. I know how to pick the lower number. That's easy. So here you got Tracy Company. They sell home heating stoves. They have gas stoves. They have wood stoves. They have pellet stoves. And here are the cost of all these stoves. And here's the market value of all these stoves. And now we have to determine the company's inventory using the lower of cost or market basis. Woohoo! So you're simply picking the lower, right? You're just picking the lower numbers. Gas stoves, you would pick the lower number. Wood stoves, you would pick the lower number. Pellet stoves, you would pick the lower number. So what is the total value? Simply add these up. So the total value of the inventory would be $430,000 for Tracy Company. That's it. I mean, there's really not much to this. But again, the purpose of the lower cost of market basis is to make sure we are not overstating the value of inventory, right? We have to be conservative in our numbers. All right. The last part of Learning Objective 3 introduces you to two pieces of financial analysis that's important. And inventory, because this is what they do for a living, they sell inventory. Analyzing inventory is critically important, okay? Well, you know, two things can happen. On the worst side of it, you can have too much inventory, right? And that's terrible because the reason you bought the inventory in the first place is to sell it. You don't want it. You want to sell it. You don't want it to sit there. And when it sits there, it costs a lot of money. It costs money for storage. You probably bought it on account and you might need to delay that. So it's going to be interest. You might need a loan for it. And then, of course, those goods, the longer they sit on the shelves, the more obsolescent and obsolete and out of fashion they become. So it loses value just sitting there. So high inventory levels are horrible for a business. Equally horrible is a low inventory level because when customers come in, they want to buy it. And if you don't have it, you can't sell it to them. So you lost a sale, right? And customers get really upset when they walk into stores and it's like, you don't have any more, but you have it advertised. You know, yeah, but we just ran out. Well, that's not good. You know, customers are going to be really upset. And that's the purpose of your business. Your purpose of your retail business is to sell your goods, sell your inventory. So you need to make sure you have it. So the analysis is very important to do because you simply want to avoid, right, having too much inventory or having too little inventory because you're in business to sell it. You're in business to sell it. It's tricky. Even Walmart, which is huge, I mean, they're really good at the inventory thing. They still have, I shop at the local Walmart here in Fishkill, and I get very frustrated with their inventory because sometimes they'll say they have something. So I'll order it through the app, and then when I go to pick it up, they're like, "Oh, we didn't have it. We ran out, or we had to do a substitution." I'm like, "Oh, I don't want that. I want this." So it's very, very frustrating to customers, and I don't get that with Amazon. Amazon, once I buy it, I know it's mine, and it's coming to the house. It might take several days to come to the house, but at least I know it's coming. So it's a little bit different. I think they have a little bit of a benefit here. So there are two pieces of financial analysis that we're going to be learning. Everything starts with the turnover ratio. Okay, how quickly, and this is a number of times per year, really, how quickly are we selling our inventory each year? Okay, and the inventory turnover ratio looks at the cost of goods sold. So that takes cost of goods sold comes right out of the income statement, and divides that by the average inventory. So average inventory, you have to do an average. You get your beginning inventory and your ending inventory. Average it out. That gives you the turnover ratio. Once you know the turnover ratio, you can actually compute the number of days you actually have your products in stock. You take that inventory turnover ratio, which is this, you put it below 365. That gives you the number of days. So let's see how it works. Here's the information for Walmart. All right, we have 2013 and 2014. 2014 is going to be the focus here. So first line here, inventory turnover ratio, right? How many times per year we are selling our inventory. So Walmart in 2014 has $358 billion, $69 million of cost of goods sold. That's the first number, cost of goods sold. We divide that by the average inventory. The average inventory is the beginning and ending inventory. So these two numbers here added together divided by 2. And it comes to 8.1 times per year. Now, if you think about it, what this means is, and I'd like you to visualize it if you could, you know how big a Walmart store is. You've been in one. Just imagine in your mind that store sells everything on the shelves and restocks everything on the shelf 8 times a year, because that's basically how you can imagine this. Okay, that's enormous because they have over 125,000 different products and on the shelves, and to know that they sell everything out and restock that store 8 times a year is just an enormous undertaking. But that's what they do. That's what they do. Now that we know it's 8.1 times a year, you can divide that over the 365 to say that basically every 45 days in 2014, Walmart has sold out of its store every 45 days. It's selling the store out every 45 days. Just outrageous, outrageous. Okay. Compare that here with Target for the same year, 2014 numbers. Now, Target's a much smaller store. Target's only about 20% the size of Walmart. It's a very, very small. So if Walmart was 10 feet tall, Target would be 2 feet tall. I mean, it's there, it exists, but it's extremely small compared to Walmart. Target has a good business model. They're doing quite well. But as you see here, they only sell out their stores 6 times a year. Right? Their inventory turnover is 6.1 times per year. So basically, if you put that below 365, they basically sell their store out every 60 days if you round it. So basically, every 2 months, that store, in how you imagine this, that store is totally sold out and restocked every 2 months, every 60 days, roughly. When you look at the industry, remember the industry would be all of these large retail department stores like a Walmart and Target. So Kohl's would be in there, among others, right? The industry average is 8.4 times a year. So they move a lot of inventory. And basically about every 43 to 44 days, on average, these stores are basically sold out and restocking, right? So this is an enormous amount of inventory to track, and um, and it's very, very important for their viability and their profitability to make sure they have the right amount of inventory in stock for sale. That's what they do for a living. They sell inventory. So this is critically important to them. Okay, so we're going to go right to the do it exercise here to look at inventory turnover for this particular company, Westmoreland. They just switched over to a just-in-time inventory system, and its information is given below for 2016 and for 2017. And they want you to do the inventory turnover ratio. So again, inventory turnover is the cost of goods sold divided by the average inventory, which means you'd have to add these two and divide by 2 to get the average. Okay, that's all it is. So you do that for 2016, you do that for 2017. As you see here, for 2016, you had $1 million of cost of goods sold. When you averaged beginning and ending inventory, you got 250, so 4 times a year. 4 times a year divided by 365 would give you about every 91 days, basically every 3 months, right? However, in 2017, they went to just in time, so they have less inventory, right? And their cost of goods sold divided by the average inventory. So when you average this, you get a much smaller denominator. And now you're selling your every 7 times a year, which is much better. The more you sell your inventory, the more revenue you make. The more revenue you make, the more profits you should be making. So basically, you're selling at your store here every 52 days this year versus last year. That's much, much better if you're a retailer. Okay, so that basically is our lesson today. Not that bad, right? Not that bad at all. Questions?